Hello traders, you're welcome back to the Forex Geek channel. In this video, we are tackling one of the most controversial strategies in Forex, and that is the Martingale Trading Strategy. Some swear by it, others call it financial suicide. Well, let us break it all down and get to the real story. So, what exactly is the Martingale strategy? Well, the Martingale strategy is simple in concept. You double your position size after every losing trade. The idea is that one win will recover all your previous losses and give you a small profit. Sounds clever, right? But in Forex, the reality is much more complex. This system originated in 18th century France as a betting method in casinos. Traders adapted it to the Forex market, hoping to take advantage of its mathematical certainty. But markets are anything but predictable. Now, you might be wondering why some traders use it. The appeal is obvious. Nobody likes losing. The martingale strategy promises that you eventually win, and when you do, you recover everything and move forward. For beginners, this can look like a fast-track method to smooth out losses, but it assumes you have unlimited capital and no trade limits, both unrealistic in real-world trading. Here's the catch. The deeper you go, the bigger your position size becomes and the faster your account can blow up. For example, let's say you entered a sell trade around here because there is a resistance. Let us be practical with the strategy. Let's say because you had a resistance around here, so you assumed that price was going to reverse, and as a result of that, you decided to sell. Maybe you decided to first of all sell around here. All right, so you decided to sell around there. Now you sold with, let's say, 0.01 lot size. Let's assume that you sold with 0.01 lot size, but sadly price broke that resistance and kept on going up. Then you look for another point where price shows rejection and you sell again, double the lot size of the previous. So in this case, you'll be using 0.02, and then price continues going up, and then you sell again with 0.04, and then price kept on going up and you sell again with 0.08, and price kept on going up and you sell again with 0.16. You see, at each level you are doubling the lot size of the previous. So that is martingale strategy. Now at this point, you entered with 0.01, here was 0.02, here was 0.04, here was 0.08, here was 0.16. Now the truth is that as the price came down to this place, you should already be in profit because the lot size you used here was 0.16, and definitely from here to here would have been in profit for lot size 0.16. Lot size 0.08 will also be in profit, and the trade with lot size 0.04 will be in a small profit. So the only trades that are going to be in loss at this particular point would have been that of 0.02 and that of 0.01. So do you see now? So, but the thing with marginal strategy is that there is no guarantee that price will eventually reverse. There could be just minor pullbacks depending on how strong the trend is. If it is a very strong trend, you might have little pullbacks, and that is the reason why martingale strategy is very risky, because you might be doubling your lot size, going on, but forgetting that your account balance is limited. You don't have unlimited balance. So at some point, if price does not reverse, you will end up using your entire available margin. And if you do that, before you know it, you might blow your account. All right. So that is the reason why, in as much as martingale can be very profitable, it is very risky at the same time. All right. It's very, very risky at the same time. The deeper you go, the more price goes against you, the bigger your position size becomes, and the faster your accounts can blow up. So if you hit a string of losses, the required margin to keep doubling becomes massive. Even with proper leverage, brokers have limits, and your margin won't stretch forever. So this is where most martingale traders get wiped out, not by bad strategy, but by bad risk management. All right? Martingale preys on our emotions. When you are losing, your instinct is to get it all back fast. And that is the reason why you will be doubling your lot size, because you are now hoping that when the price begins to reverse, because your lot size is now bigger, it will take less number of pips to recover the loss. You understand? Because if you had entered a 0.02 here, it will take less number of pips to recover the loss given by 0.01. It will take less number of pips to recover the loss given by 0.02 when you are using 0.04, and so on and so forth. All right? So this strategy feeds that urge, but without strict money management rules, clear maximum loss limits, and emotional discipline, you are playing with fire. So if you are considering using martingale, you should ask yourself, do I have a backup plan when things go south? Ensure that you have a solid answer to that question. Do I have a backup plan when things go south? Martingale works until it doesn't. And when it fails big. It fails big when it fails. All right. So, is the Forex Martingale trading strategy a smart technique or just disguised gambling? Well, that is up to you to decide. But know the risks before you commit your capital. It is very, very important. You need to understand the risk lying therein before you commit your capital. All right. So if this video helped you understand the strategy better, hit that like button and subscribe for more straight to the point Forex content like this. See you in the next one. And remember, trade smart, not emotional.